Okay guys, so in today's video we are going to cover a deferred tax. So this is the continuation. So this is our part 3 of deferred tax. However guys, so in this video there is also some transactions that are going to be related to IAS 16, which is PPE. So please make sure that you watch until the end so that you're gonna gain more knowledge when it comes to these two standards. And the other standard guys that we are also going to cover. Okay, now let's start with our question. So in this question paper we are going to do a journal entries or general journals. Okay, they say DHL Ltd is well-established company based in Gauteng province, and DHL Ltd was listed on the JSE Ltd in 2015. The company has 31 December reporting date. So our year, every year end 31 December. Okay. The following information related to 2021 reporting period. Number one, they said profit before tax for 2021 reporting period amounted to 10,684,000 after considering the following. Okay, so basically the profit before tax that they give us, we can use it if we are preparing, like for example, a correction of income statement, which means that we need to start with that balance of profit before tax, then we do the adjustment. But in this case we are going to do the journal entry and we are going to treat all the transaction that we have. Okay, number 1.1, they said depreciation on machine is 550,000 for 2021 reporting period. Okay, 2021 reporting period is our current year. Our current year is 2021 because we're doing for period. Let me write it here. Journal entries for year end 31 December 2021. Okay, just like this. All right, we're gonna have our debit side and our credit side. This side we're gonna write details of the journal. Okay. Yes, now let's continue. They said our depreciation is 550 and the sales allow wear and tears on this machine at a rate of 600,000 per annum. Once you see this kind of transaction, guys, obviously you know that you are going to deal with a deferred tax or implication of IAS 12. Okay, as you can see, we have the difference between our depreciation in accounting and our wear and tears in taxation, which means that there is going to be rise of what temporary different, which we need to adjust it. Okay, but this depreciation, guys, is for current year. Simple means that we still have to adjust it first. Okay, the first one, we are going to say our depreciation is an expense. We debit it. Depreciation, which is P&L, and accumulated depreciation, which is SFP, because it's negative assets, is going to be 550 this side and this side here. But when it comes to wear and tears, guys, once we see wear and tears in financial accounting or in accounting, yeah, you are in a serious trouble, because wear and tears are recognized in the books of taxation or in the module of taxation, not here. What we do here is only deferred tax, temporary different that has arisen. You don't record wear and tears here. It's not allowed in IFRS. Okay, now we have to check so that we can do our what? Our deferred tax, because already we have noticed that in accounting we claim less allowance, in other words, or depreciation, because we claim 550 instead of 600. In other words, if you claim less expense, you are going to get more profit, which means that on our side, we eat more profit instead of eating less profit, because SARS never go wrong. It's always right in terms of IAS 12, which means that we have to take the side of SARS. In other words, in this case, simply means that we are owing SARS. Why are we owing SARS? Because we claim less expense. And when you claim less expense, you get higher profit. Instead of getting less profit, you get higher profit, which means that you must bring back some profit that you have made, which means that this is going to be deferred tax liability. How do you draw deferred tax liability journal? Very simple. You make sure that on your debit side, your deferred tax must be P and L. In other words, this is the side of expense. And deferred tax of SFP must be statement of financial position, must be on the credit side, representing what? Increasing liability, increasing expense. So how much are we going to record? Obviously, the difference between 600 minus 550 is going to give you 50,000. This is what we call it, different. Temporary different. Simple. That's what is needed under number 1.1. However, if you continue to read it, they also stated that the estimated useful life is 10 years, and the carrying amount on 1 January, it was amount of 4,904,167. So that other information, we are going to do it when we are preparing PPE. Make sure that after this video, go and check PPE in terms of IAS 16. We prepare it using the same question paper. Okay, which means that in this case, we are not going to do what? We are not going to recognize the purchase of this machine because it was purchased in 2019 and we are doing for period 2021. Simply means that it was already recorded in 2019. No need to record it. Okay, 1.2. Dividend income of 300,000 from a company whom DHL Ltd has invested. Okay, withholding tax was correctly accounted for financial record of investee. Let's start by normal transaction, and after that we're gonna do what? We're gonna check if we need to do deferred tax. Okay, we receive dividends. Of course, if we receive dividends, our bank is full. Simple. And dividends is income, we have to credit dividends income. This is other income under P and L. Okay, and the amount is 300,000. 300,000. Very simple. Now let's go to deferred tax issue. They said that withholding tax was correctly accounted in the financial record of investee. As DHL, we are investor. Investee is that company that we invested into. Simple means that they're saying that all the taxes, they are already paid by investee. Investee is the one who account for anything, for everything. Simple means that in our books, no need to account for deferred tax. Simple means that we are done with this transaction. Okay. On 1 September 2021, DHL Ltd purchased a production plant by amount of 7 million, I mean. Okay. And in this case, obviously, we also have to read the note. They say tax rate is 28%, discount rate is 15%, and you have to ignore the effect of VAT. So simply means that this 7 million, don't worry about taking out VAT. If it's VAT inclusive, you need to take out VAT in terms of IAS 16. VAT is not allowed under a cost of a PPE item. Okay, Let's continue now. It was bought cash and the plant was installed and tested on the same day by the cost of 60,000. Installation obviously form part of cost, but we need to recognize this. Okay, now we are going to say, number one, we are going to recognize plant. We are going to say it plant. Okay, you can do it in this way or you can combine all of them together, but I prefer to do them separate in case if you did a mistake somewhere, so that you can get marks on the other journals. SFP and bank. SFP simple means that we're gonna say 7 million. Okay, then after that you can come to the plant was installed and tested. We are going to say plant installation, SFP. This is going to form part of cost, and we're gonna say bank. They didn't specify whether we install it by cash or credit, so we assume that it's cash. They can't pay 7 million and fail to pay 60,000 as well on the same day. It can't be credit, it's cash. Okay, SFP. Okay, now we have done compiling this to journal, but we are not done. This transaction is very long. You can see it's almost like a paragraph. So we have to analyze it step by step so that you will be able to do it in all marks. Okay, as you can see, this transaction, this only 5 transactions have 45 marks. So you need to be careful. Wherever that you need to show calculation, you have to do that. Okay, now let's check. They said that the plant was ready and available for use on 1 September 2021, which means that when we calculate depreciation, we're going to check only 4 months, September, October, November, December, because it was available for use on 1 September. Okay, on 1 September 2021, it was also estimated that the cost of removing the plant in 10 years will be 450,000. The removal of the plant is required by local environment authority. This is what we call dismantling cost. We call it dismantling cost. Dismantling cost. Okay, dismantling cost is like, for example, for good example, you know that some company that they are producing what example can I give? Okay, maybe it's a car production. You know that when you are producing a car, there is a higher possibility that there will be air pollution. Okay, yeah, let's say air pollution. You know that air pollution destroy, I think it's called ozone layer or whatever. It's something like a science stream. Yeah, but you know what I'm talking about. So in order for you to get approval so that you can be allowed to destroy that ozone layer, you need to pay to government. It's not free. Like if you have a company that you have to dump some material that are not going to be useful again, there is a dumping area that you can just throw those things. So you need to pay that amount. You need to you have to be allowed so that after you have done with your production, you can dump your pieces there. So you need to pay what we call dismantling cost. If you are running a professional business in terms of IAS 16, you need to pay this dismantling cost. So we call it dismantling cost. So this dismantling cost, guys, they give us amount which we call it a future value, because they said that it's going to be, it was estimated that the cost of removing plant in 10 years will be 450, and the removal plant is required by local environment authority. Authority required that. It's a must for them, which means that this is also going to form part of a cost of this a plant, because if we don't pay this dismantling cost, this machine is not going to be to operate. It's not going to be operate, because this local environment authority, they are going to come and stop you to do what? To produce. Okay, which means that this 450, now we have to go back to principle of IAS 16. They said that interest are not allowed in terms of cost price of PPE item. Simple means that we also have to do what? To take out interest. In other words, this amount of 450 is future value. This amount is future value. So if this amount is future value, simple means that it has what? Interest. If we want to take out interest, we must do what? We must convert it into present value, which means that we need to find our I, our N, our PMT, then our answer will be present value. Okay, now let's do it. We know that future value, you have to put a negative in your financial calculator. Our I, if you check on the note, they said the discount rate is 15%, and they already told us that this is going to be removed after 10 years. And PMT, we are not going to pay any installment every month, so it's zero. We only have future value. This is the only balance that we have. Okay, then if you do this calculation, guys, you are going to get a present value of 111,233, which means that our dismantling cost that we are now going to recognize in our books, we're gonna have dismantling cost of 110. We are going to say planned, and we say dismantling cost, SFP. Okay, then we're gonna have this is going to be a finance, so it's not going to be a bank because it's not cash. Okay, so the amount will be 111,233. Okay, just like that. Okay, now after you have calculated your present value every time, every transaction, you have to make sure that the following transaction must be interest, because you remove what? Interest. Interest is not part of cost. That's why we remove it under a cost price. Now we want to show the interest separate. How are you going to calculate interest? It's very simple. You are going to say interest expense okay, you can indicate that it's finance SFP. Finance simple means that we have what? A liability increase. Okay, then how are we going to calculate it? We're going to say 111,233 multiplied by 15%. But remember, it's only 4 months, so we also have to count a month when we calculate what? Interest. So we're going to also count from September, October, November, December. Is going to be 4 over 12. Then it will give you 5,562. 5,562. Okay, just like that. That's how you should prepare this journal. But it's not done. We are not done with this transaction because they said that we also have to account for depreciation. Okay, let's continue. Now let's come this side. Okay, we need to account for depreciation now. Okay, then we have our journal entry, and our journal entry, this is how we are going to do it. Okay, the following one is a depreciation, which we are going to debit depreciation, and we're gonna have accumulated depreciation. Okay, now how are we going to calculate a depreciation? It's very simple. We must first add everything that forms part of a cost, which is 7 million, number one. Number two, we are going to add installation of 60,000, and we are going to add a dismantling cost of 111,233. Okay, I think that's all that form part of cost price in this case. Then after that, we're gonna say 7 million plus 60,000. Then we add 111,233. Then it's gonna give us 7,171,233. And we divide by useful life of 10 years, and we multiply by 4/12 because we use it from 1 September. Divide by 10, multiply by 4/12. Then it's gonna give us 239 and 41. Okay, it's 239 and 41. 239 and 41. Just like that. Very simple. Very simple. Okay, now let's proceed to the next one. The next transaction, they said that on 29 December, okay, no, we are not done, guys. We also have to test what we called temporary different. SARS allow when tier straight line basis over 10 years. Okay, SARS is using 10 years, and in accounting we are also using 10 years. What will be the different? The different is that when it comes to SARS, there's no dismantling cost, which means that their cost price is going to be 7,060,000 divided by 10. There's no dismantling cost in transaction, which means that their when TS is going to be 706 multiplied by 4/12. It's going to be 235 on their side. 4/12. It's going to be 235,333, which means that temporary different is going to be 235,333. Okay, minus 239,041. 3,708. 3,708. 3,708. 3,708. 3708. Okay, this will be like the previous one, so we're gonna have liability because our depreciation is less. So it's income tax P&L and deferred tax, SFP, just like that. Okay, the next transaction we are going to have on 29 December, we have 1.5 million that was received from customer for goods that will be delivered for January 2022 next year. The financial accountant recognized 1.5 as revenue in the financial statement of reporting period end 31 December 2021. SARS taxes income in full at settlement early of receipt and accrual. In other words, SARS only takes if business has delivered to customer, not if they receive money, when they deliver to customer. So in other words, simply means that they can't tax this amount because this amount is for goods that is going to be delivered next year. So what do we do in this case? We have to make a correction because this accountant recognizes it as a revenue, and it's not revenue because we haven't yet delivered. This is income received in advance. So how do we cancel it? We cancel it by saying a revenue and we said income received in advance. P&L, SFP. Then amount is how much? It's 1.5 million. 1.5 million, just like that. Okay, then the last one, they say depreciation on vehicle amounting to 350. SARS allow annual wear and tears on the vehicle of 218,750. Vehicle was bought in 2019 at the cost of 1,750,000. Okay, so in this transaction, most of the information that they provide to us is for us to calculate what we call PPE item. So they already calculated depreciation because this vehicle was purchased last year or last of last year, 2019. Simply means that no need for us to account for it. We're just gonna recognize depreciation and defer tax. Okay, depreciation P&L and accumulated depreciation SFP, which is going to be how much? 350. In this case, because we claim more, we have deferred tax assets. Okay, we're gonna have our deferred tax SFP on the debit side, then income tax on the credit. Okay, then amount, you're just gonna say 350 minus wear and tears was how much? Wear and tears was 218. 750. Then you will get the answer this side. So I hope you learned something, guys. Please make sure that you subscribe, go and watch part 1 and 2 and other videos of accounting standards that are related to whatever that you are doing. I'm gonna see you on the next one.